The Money Show.
Personal Finance with Warren Ingram.
Ready to have a lot of fun tonight in terms of the personal finance feature, joined by Warren Ingram, the co-founder of Galileo Capital. He wants to talk to us about how you can be the Roger Federer of investing. Now, that's all about one of the all-time great tennis players, Roger Federer, recently giving a commencement speech at Dartmouth University in the USA. And clearly, Warren Ingram taking some of those gems and applying them in terms of investing. But before we go to Warren, I want us to listen to that particular clip and what Federer had to say. And then Warren will explain how we can use this in terms of investing.
Perfection is impossible. In the 1,526 singles matches, I won almost 80% of those matches. Now, what percentage of points do you think I won in those matches? Only 54%. In other words, even top-ranked tennis players win barely more than half of the points they play. When you're playing a point, it has to be the most important thing in the world, and it is. But when it's behind you, it's behind you.
Great words there from a great Grand Slam tennis player. Joining us now, of course, Warren Ingram, co-founder of Galileo Capital, in our personal finance feature. I'm not a great tennis player, Warren, but you certainly can teach us how to be a great investors using some of those analogies coming through from Roger Federer.
You know, Motheo, nor am I a great tennis player. So, if we had to go and get to the court today and say, okay, we're going to flip a coin to see who wins. That's kind of how most people feel about investing, because they have this time horizon which is really short. You know, they get excited about investing because they read a fancy tweet, or their friend tells them, over the weekend that they made a huge amount of money buying some new share on the stock exchange. And then, people take their money and it's hard earned money, difficult to save, and they take it, they put it in the market, and then they spend every minute of every day watching it. And you know what happens now, Motheo, it goes down. So, investing is not unfortunately, it's not kind of a high speed, high action thing. That's called speculating, and speculating and gambling kind of relate to each other. So I would say we want to look at the way Federer spoke in that clip, and it's very easy for you and I to be Federers of investing. I don't think I'm ever going to be able to get on a court and move like he did, that's for sure, but we can. So the first thing is, when you start your investment, you've got to say to yourself, the longer I give the money to work, the better. And if you arrive with impatience, if you arrive expecting to get great returns by the end of the day, what you need to know is your chances of making money in the stock market after one day are probably 54% in favor of making money and round about 46% in favor of losing money. In other words, flip a coin, and that's about the same sort of chances you've got of making money. Choose heads or tails. That's pretty much what happens with investing. Slightly in favor of making money. And I don't know about you, but I work hard, and I don't really want to go and flip a coin every day to go and see how I'm going to make money. I want a bit more odds than that.
Now, Federer has a 24-year career, right? A career spanning 24 years. He's 41 years. And that value of time when it comes to investing as well. A great example here that, you start early, you put in the time, and you work hard for a longer period, especially when you're investing, so that when you get to times when things aren't working out and the value of a portfolio is down, you don't panic, you still push on.
Exactly right. And what you want to take from this when you're listening to Federer is, you can't get every call right. You can't be perfect. You can't time the markets correctly. It's actually a wonderful idea in a textbook and in a movie, but in reality, impossible to be perfect. So you give yourself a long period of time when you decide to invest money. What that allows you to do is ride the bad times along with the good times. And the longer you leave the money, the better your chances of getting some growth. Because actually what happens is the moment you move your time horizon out for your money, we've spoken about what happens on a day. 54% is in favor of making money. And that's a bit like Federer's number of points. He won 80% of his games by winning 54% of his points. And he did that for a long period of time. He was super consistent. And consistency is important here, because the moment you say to yourself, let me give my money 5 years to grow, your chances of making money are around 93%. So 93% of the time, the money you start with today, you put in 1,000. In 5 years' time, it's likely to be more than 1,000. It could be a great deal more, or it could be slightly more. That none of us are going to know. But if you keep going, eventually after 10 years, you've got a 97% chance of making money. And if you get to Federer's career, 20 years, you've got a 100% chance of making money. In other words, almost guaranteed that nothing in life is guaranteed, but almost guaranteed that if you stay patient, you stay in, you keep going, you keep investing, you are going to make good money when you wait and you are patient. You don't need to be a genius. You don't need to be a rocket scientist or a financial guru. You just need patience. And it's an incredibly easy thing for me to tell you and really hard to do.
Now, looking at Roger Federer's own career, started quite young, went into it early, but also let's not overlook the hard work as he gets to the twilight years of his career, the hard work over the years. And investing also comes with a lot of hard work. That hard work being the research that you need to do, your own assessment of the portfolio as it goes along, the discipline to stay the course as well. Tell us more how we can align ourselves in terms of a world-beating athlete does in terms of putting in the discipline, putting in the work to make sure that you succeed.
I think one of the toughest things to do is you've got to fight the kind of outside influences on your investment decision. So we chatted a little bit already about FOMO, fear of missing out, and whenever there is a craze, whether it's a craze about some way to make money, or equally kind of a tidal wave of fear that arrives that's trying to convince people to sell their investments and run away. In both instances, your biggest job is kind of to ignore the noise. Your biggest job is to say, that's someone else's problem. I've got a game. My strategy is I've got a 5 to 20 year time horizon, and I'm not going to sell. I'm going to stay invested. And I think it's important to understand that most people can't stay the course. They can't stay disciplined with their money. It takes, it's not a rocket science thing. It's not about having a superior intellect. What it is about is having the discipline and the self-confidence to say, even if you've bought an index, Motheo, if you just said, I'm going to buy the top 50 index in South Africa and the world index overseas, all I'm going to do is I'm going to buy it and I'm going to hold it. And when you read about elections, and if we're talking about global now, you look at the US election is coming, and everyone's terrified about Trump coming in, but equally, the other half of the investors are terrified about Biden staying in. And I don't know what to do. I can't make a decision. And what I do know is that I would be hyped into either selling or buying more if I base my decisions on someone else's view. What I need to do is say, my job is to stay invested for a long period of time. So whatever happens in this election, I'm not going to worry about it. I'm not going to sell before, and I'm not going to sell in panic afterwards. And I'm just thinking about what's happened in our country with our election. People were deeply fearful before the elections. You could see it in car sales. You could even see it in alcohol sales. Everything was down. No one was doing anything. The market was weak. The rand was really weak. Now we've had an election result that, depending on who you are, you might have predicted it. I didn't. I don't have any crystal ball, but the rand is really strong. The market's pumping. What happened to those people that sold out? Because they didn't predict it. So they haven't jumped in time to get the recovery. The kind of mundane, slow and steady investors gone in before and said, every January I put my money in and I leave it there, and next January I'll add some more. They've had a great recovery to the beginning of this year, and they've done nothing super intelligent. They've just been disciplined and stayed the course. And that's my view here. You've got to be disciplined. Give your money a chance to work in your favor, which means don't chop and change. Don't listen to all the fear mongers, all the people hyping up a particular share or a particular crypto or whatever it is. Your job, long-term capital growth.
Playing the long game is always quite important in terms of investment and getting better returns. But other people will tell you in the short term, there are opportunities still. I would like to take some of the money that I have over long term and try, I won't say gamble it, and try and invest it over a short period of time with the outlook that I might get a better return over the short term.
That sounds a little bit like another tennis player called Nick Kyrgios. Now he's got all the talent in the world and no patience and no discipline. So guess where he is? He's not at the top. He looks amazing. Every now and then he has a fantastic game and he looks really stylish and everyone raves about him. And then, the game after that, he's put no effort in and he's impatient and he blows up at, himself or the umpire and he's gone and he disappears again. Now that's not the career you want. You don't want to get to the point where your money blows up and disappears on you. And you certainly don't want to be kind of trying to aim for the flash when it comes to, chasing the kind of shiny object in the markets, whatever that is, whatever the new big growth story is, because then you're curious and it's going to be really exciting. But the one thing you want to know about investing is if it's exciting, if you're having lots of fun, you're doing it wrong. Great investors are not exciting in their careers. I'm not saying anything about their home lives and what they do with their friends. I'm talking about when it comes to committing money, what they do is slow and steady over long periods of time. And they become the Federer. They become the Djokovic. They don't become the Kyrgios who just blows up and fades out. And that's my view here is you can't be doing this for fun or for impressing people. This is really serious stuff. It's really kind of boring if you do it correctly.
Well, if you're wondering why we're talking tennis on the business show, we're currently going through the personal finance feature here on The Money Show, and Warren Ingram, the co-founder of Galileo Capital, telling us how we can be the Roger Federers of investing. Do join us for this conversation after this.
The Money Show.
Personal Finance with Warren Ingram.
And no, he's not a tennis coach. He's the co-founder of Galileo Capital, Warren Ingram, telling us how we could be the Roger Federers of investing. Let's pick up that conversation around selling the losers in your portfolio. I do imagine that Roger Federer has changed a few coaches in his career. And when things aren't working out, you want to not rework your strategy, but just tinker a little bit with it in order to make sure that you end up with a portfolio that's winning.
That's absolutely right. I think, you want to review your strategy probably once a year. At most twice a year. So if nothing's changed in life, you haven't got married, divorced, had children or anything like that, then you're reviewing your strategy once a year just to make sure that, your earnings and your savings rates are good and it aligns with your investment strategy. And the most important thing when you're looking at your investment strategy is what proportion of my money have I got in shares? What have I put into the stock market? And then, how have I balanced that with something, more conservative like cash, government bonds and maybe, listed property companies. So that's called your asset allocation. And that mix of assets is really important. The engine of growth will be your allocation to the stock market. And that should be a good proportion of your money. So, if you're young, Motheo, and you've got kind of 30 years to go, the last thing you do is take, the bulk of your money and put it into cash, because what you've done now is guaranteed that it's your money is not going to grow very fast at all. What you are going to do is pay lots of tax on your interest and you might track inflation if you're very lucky. So you want your engine, to be the stock market and that should be the bulk of the money. And then the cash and everything else are kind of stabilizers in the portfolio. So once a year, making sure that you've got the correct allocation to shares, that it's not too big or too small, that makes a huge amount of sense to me. If we're talking about individual shares and looking at the shares that have done well and those that haven't done well, those that are losing money, I think reviewing that decision maybe every 3 months, but actually every 6 months still makes sense, because you need to understand why the share has gone down before you sell it. For example, if it's a mining share and the mining sector has been, hit by low prices, that's not necessarily a reason to sell the mining share. That means you need to understand that the sector might come back. Prices of resources might rise again, and all you need to do is be patient. But if you own Nvidia shares and that's the kind of chip manufacturer in America, And those shares have gone through the roof and they're up 700%. And that's now kind of represents 30% of your portfolio. Maybe you want to sell some and rebalance your portfolio, because what you don't want is your 30% share to become the zero value share. Something blows up and you lose all your money. So then you want to review. But I think I would always be very slow to sell, a share that's down because the sector's down. I'd be quick to sell a share when they've got, corruption or something going bad in the company, like when they've got culture issues. That's a good reason to sell.
Because it's hard to come back.
But you need to understand why before you make the sell. Don't just sell because it's down.
And then looking at, maybe give us two strategies you can look at investing over a long term, strategies that will make sure that you stay the course and make sure that you have higher returns at the end of it. The likes of Warren Buffett have done it. They've always preached around playing the long game. But what are those strategies that people can look at as investors?
Give yourself the job that when you buy an investment in the stock market, your plan is that you may not sell it for the next 5 years. If you can have that sort of mental approach, then it makes you think much more carefully about what you buy, because you can't just sell it tomorrow. That's not allowed in the rules that you've set for yourself. And so typically that means, I'm going to encourage people to think about buying an index, buy a world index if it's your first investment, buy the top 40 or top 50 index in South Africa and blend the two together, because those are things you can hold for 20 or 30 years, never having to sell. You're never going to be worrying about an individual winner or loser in an index. You just ride the index and earn the dividends, and then make sure that you keep reinvesting. But if you want to take individual share views as well, then it can be a complement to the index. But then don't let an individual share become 20 or 30% of your holdings. Make sure it's 2 or 3% and own a few of them. And those could be kind of the satellite investments, and the satellites go around the sun. And in this instance, the sun is your index. And so you've got this core and satellite approach. And to me, that's a very valuable way of being able to stay consistent and stay invested, Motheo. And I think for me, I would give myself another rule, which is once I bought it, try never to sell it. Don't be impatient. Try and hold it for as long as you possibly can.
And then looking at some of the things I need to look at in terms of costs, things like taxes in a portfolio. What are things that can jump at me once I want to draw down on a successful portfolio that's been there for 30 plus years?
Yeah, that's a great point. So you need to know that if you've held a share or any capital investment for longer than 3 years, that in South Africa, you're going to pay capital gains tax on the growth. So if you put in 100 and it's now worth 1,000, then you're going to pay tax on the growth of 900 Rand. That might sound like a lot, but your capital gains tax at worst will be around 18%. And I know that seems like a huge amount of money, but it's much better than income tax, which is at 45% at worst. So you're trying to make capital gains. You're trying to make sure that you get long-term growth.
Yeah.
So understanding that you are going to pay those taxes, but along the way, you're going to earn some dividends, and those will be tax-free for you because the company would have paid those taxes on your behalf. And to me, those are the two things.
The listener's question as well before we let you go. We are quickly running out of time today. I've received a contract to work abroad. Now, this is the listener that has sent us this question. He says, I've received a contract to work abroad for the next 2 to 3 years. I plan to come back to retire in South Africa. How should I invest the money that I'll be earning abroad? And I have some retirement funds that will be preserved in South Africa. So how does he manage his money there?
Yeah, that's a great question. So definitely, when you know you're going overseas for a while and you're coming back, then make sure that you put your retirement funds into a preservation so that you don't pay tax on that money and it allows it to continue growing. I think the very next thing you do is you pay and be happy to pay, but pay a tax advisor to give you proper tax advice. Our tax laws and the way that we treat our residents that go overseas for a while are very complicated. So make sure you get some good tax advice. And then if you don't need any assets or any expenses covered in South Africa, then try and build up your overseas portfolio with that money that you're earning overseas and give yourself a head start there to kind of get your offshore allocation going. So when you come back, you know you've already got a chunk of your money invested overseas, and then you can use rands from the new money that you're earning in South Africa. You can use the rands to start building up a South African base to complement your retirement funds. That would be my call.
That was your personal finance feature. Of course, a lot to say, a lot to teach us. Warren Ingram, the co-founder of Galileo Capital, thank you so much for this conversation, teaching us how we could be the Roger Federers of investing.